Hey guys, as promised, I'm going to do a video on the concept of boxing. The main purpose of boxing is in order to lock in, and let's just do this really fast here. Let's just add a note to lock in the borrow on the front side of a move to be able to go short on the backside when borrows are more scarce or nil. The idea, and we're going to talk about this from the short side, we're not going to talk about this from the long side. You know, you could hedge a long position just the same as a short. This can also be used as a technique to limit overnight risk of being squeezed. Because let's face it, on the front side of a move, you have a very large risk of being squeezed when you're shorting early. Another way of employing the boxing strategy is to protect against greed. We're going to put the exclamation point because that's a big one. And I'll explain each three of these and go into a little bit more depth here. So let's take an example of a chart. Let's say this is the daily. And here's the daily chart. It's gone here, a little bit of pop, a little spike, a little pop, and then you get down here. Basically, overall, you can see you're in a huge downtrend. And that's really not the big thing to pay attention to. Is, let's say this is 5, and this is 1. So you want to have a very, very, very overextended daily chart. You want to have something that's, you know, exploding. So let's say this is day 1 here, candle, finishes green. We'll leave an open candle for green. And then day 2, you're gapping up here. We don't know where it's going to finish. So let's just use this line as the opening price of the candle. And then let's dive into what the intraday might look like on the front side of a move. So here's our intraday chart. We're just going to use this as pre-market. We'll look at this as volume. Let's say our pre-market action is a bit like this. Market open, we have a big spike. Pull back, another spike. We'll reach a peak here. Let's say if we refer up here, we reach a peak right around that whole $1.05. And we pull back hard. All the way to this support level. Okay? So this support level defends, so it's still front side. It bounces, pulls back, bounces again, pulls back, bounces, and now you're looking to short it. And you know that this move is likely to end, so what your plan is you want to short it and swing it, because now this stock has went from 1 to 5, and you think that now there's a chance that if it dies, you know, you're going to be greatly rewarded. So let's say you short here at 450. Okay. The stock pulls back, bounces, fails that level, so now you're thinking it's time to cover. Okay, you're just short right now. You have no long position or anything else. You're just net short. Now, you don't take this profit down here at, let's say, this level is 4, because you're greedy and you think that there's more meat on the bone because it's up from 1. Now, this stock is a low float. It bounces around, rips back up, slowly trends through. Now right here you got to make a decision, okay? When it's starting to do this, you're up 50 cents a share. In my opinion, this is how I would manage the position. Let's say this level right here is 440. It's the worst 4 I've ever drawn, sorry. You're going to take off half right there for a little profit, just to pad the wallet. Okay. Now, what you want to do is you want to game plan that if it goes through your average, you're going to long the same share count you have left over. So let's say you have 500 shares. I'm not going to write that, sorry. I'll type it. 500 shares short. So equal to 450. So now you're going to go long 500 shares. Long equal to 450. Because now this is a negative position, right? And this is a positive position. So they're going to cancel each other out, and you're going to result in 0, right? Because as the price goes up, your short is going to draw down the money, right? Its capital is going to draw down. You're going to be losing in this position, but your long is going to be gaining the equal amount of profit you're losing. So at any time your net short or your net 0, you're flat on the position. And let's say that you don't know when to exit and you end up taking both of these positions off and you think you're about to lose big. No, let's say that you're down $1,000 on the short, okay? But in reality, at the same time you're down 1,000, you are also plus 1,000 on the long side. So again, what is that? 0, right? Less slippage in commissions. Because if you're going to exit the short, you're probably going to hit the bid. So that's going to be losing a penny. And if you're exiting the long, you're going to lose a penny on that by hitting the ask. You're going to create a 2-cent spread between the net position, right? So you're really down 2 cents, or basically a flat position. You didn't really lose anything. You protected yourself from the squeeze, and you just allowed one account to draw down in capital from the other. Okay, now let's get back to this chart. So we're going to go, oh, come on, long at 450. Whoops. Okay, now let's say that the chart continues and just goes parabolic right here, okay? So now you're long and short at 450, and price is now way up here, okay? So let's go back to our daily candle. We've now finished on the day like this, okay? Remember, our overall position is 450, okay? But we're technically being squeezed on the short, but we are hedging it with a long at 450. And the reason why we're doing this is because, one, we were greedy. didn't take profit at a reasonable target on the front side. Wanted to hold short overnight in the event of a gap down the next day. All right, so now let's look at the next trading day. Let's say that the next trading day we're gapping down. So now our long position is losing money, right? So now our next day is here. Pre-market here is, oops. This is 5.5 from the prior day where we finished up here. And we're gapping down pre-market like so. Now, we have to make a decision now, okay? Let's say red-green. Let's say this price right here. This is what you call red-green. This is the prior day close. Let's say that that is 5.5. Okay? So now what we're going to do is in the morning time, whenever this opens, our risk becomes 5.5 or red-green. Okay? So now when the stock opens and price goes here, we're going to sell our long position here with risk. If it gets through green, we take off our short, okay, and it's a loss at that point, just a typical loss. So we're going to exit long. So now we are net short 500 shares at the long exit price, because that is the last point of where we have offset our short loss, okay? So now let's say our long exit was 530. Risk is 550. $0.20 a share. Now, if price breaks 550, we take a loss. What's our loss? 20 cents a share, right? Because remember, the net short is being drawn down, right? Because we're losing, we're getting squeezed. But the long position is also offsetting that loss, okay? So now, once we unbox, what we call unbox, and we exit our long position to go net short, our average, in theory and mathematically, becomes where we exited our long position, because now we are assuming a true updraw in capital, so an increase in capital, so a profit, or a drawdown, or a loss, okay? So 20 cents a share is the loss if stopped out and we unboxed at the wrong time. And we have plenty of reward to the downside, okay? So now we have a profit target. It's gapping down, okay? That's confirmation that longs are worried, right? It's a gap down. After two big gap up days, it's gapping down, okay? So longs are worried. Price pushes to red to green, fails. We've already exited our long position into strength. Okay, we're selling into strength. We are anticipating a move like so. Pulls back, new lows on the day, bounce. Let's say it's probably got VWAP doing this number. Let's use a blue marker for the VWAP and a smaller thing. Let's say VWAP is doing something like this, and then VWAP is probably going to continue like that. But now price is probably going to bounce here to VWAP, reject, and we're just going to continue to dwindle down and fade off for the rest of the day, bounce here, finish here, like that, and so on, okay? So we've exited our long position here, all right? Let's just finish out our VWAP thing. That's probably where VWAP will finish, okay? VWAP is very easy to draw, in my opinion. It's not really necessary to have on a chart, but it's a good visual. You can almost, once you learn how VWAP is calculated and visually look at charts, and it's very easy to find the VWAP line mentally or a rough estimate of it. So we've exited our long position. We are now net short from 530 because that was our exit on the long, right? And now let's say this last price down here, all the way down here, low a day, let's say low a day, 380. Okay, so now we've exited our long at 530. We got to make a decision. Are we going to pull back here and take the profit, or are we going to hold for the much larger profit opportunity? If I were unboxing a position up here at 530, I'd probably be swinging this, okay, with risk the entire day on red-green, all right? And then, no, let me rephrase that. I would not use risk as red-green all day. Once this level rejects right here, once this level rejects, that becomes new risk, okay? You want to move your risk level down. That way, if this level breaks, you're at least cutting off everything for a profit and you've played a pattern, okay? So now you're wanting to continue to move your risk level down as time goes on and continue to swing this position as time goes on. So now, let's say you are down, 500 shares on a $5 stock. Let's say you were negative 1,000 short, but you had a positive 1,000 gain or long, okay? So you were still net zero, right? If you are down 1,000 and up 1,000 at the time that you exit, whatever amount of money it draws down here is what you will make profit in the end, okay? So in theory, if where you boxed up long exceeds, there is a possibility of you making profit on both sides of your trade, okay? So let's say that you boxed it up at 450, right? Okay. Now you have exited at 530 exit, okay? Let me just write this here. Once price has broken original, sorry, let me do this, average cost of short position, you are now profitable on both sides, right? Because
You've already realized $1,000 on the long side because you unboxed at 530 from 450. Again, I know this math isn't probably going to work exactly right because I'm doing it all rough here. You can calculate it exactly if you want to. I encourage you to. But once price has broken the average cost of a short position, you're now profitable on both sides because you now have made $1,000 long. You've unboxed net short up here from 530. So this drawdown right here has become less and less and less. And now you are up on both sides of the trade. Okay. You guys can work all through the math and everything like that. I'm just explaining the concept of this, okay, and how it would be used to, one, protect against greed because you were greedy and didn't take profit right here because you were shorting on the front side of a move, okay, and even though you didn't unbox at the top, you unboxed when everybody else wanted it short because on a big day, on a big move like this, the first time it's gapping down, everybody's going to want to short that crap. Right? Everybody's going to want the shares, everybody's going to want the borrow, and everybody's going to be fighting for it. So ultimately, you end up with a chart that looks like this. Okay? You end up with a chart that looks like that. This is your profit margin, and so on and so forth. So that's the concept of why I would box a position. It's nothing to be afraid of, but you do have to understand that if you're you have to have enough capital in your account to be able to handle a drawdown, okay? So if you have, let's just kind of do some rough math here. If you have 500 shares at 450, that is equal to a position size of 2250, okay? So now, if this goes to, if the price doubles from your position, you're going to lose what you put into it. In my opinion, here's what you need to do if you're going to do this type of stuff is never let drawdown exceed 50% of total capital in account, okay? So basically what that rule means is that if you're shorting 2250 and you could potentially, get squeezed to 9, right? If this goes to 9, you have lost $2,250. You have a $2,250 drawdown on top of the margin that is required for the short. So you need to have, $4,500 in your account to be a 100% capital drawdown. Okay, again, it's not a loss until you unbox net short. You're just exchanging capital between accounts, right? If I have one account over here that, is the idea, I've got one short over here and then one long over here, okay, just in two accounts. Really what's happening is, I've got a exchange happening here. I've also got an exchange happening here, all at the same time to offset one another, right? Let's say this is the long and this is the short, right? But here's the risk you have to realize about not letting it draw down all of your capital. I use this 50% rule to hedge against margin calls. Okay, so you don't want avoid margin calls at either T plus 3 on shares, on share availability, or 5% margin call on equity drawdown of account. Basically, when you're down too much on a short position and the remainder equity is like drawing down from that short, you may get a margin call when your account is below 5% left of what that position is. So that's just a way to avoid a margin call. And remember, if you're doing this on a stock below 250, remember the 250 rule, and so on and so forth. So I hope this video has helped you guys. I hope this explains what I was talking about to a lot of you guys in chat. And if you have any questions about it or any critique, again, boxing is not, in my opinion, a strategy. It's an art. Everybody does it a little bit differently. Everybody uses this strategy a little bit differently. So that's why it makes it more of an art rather than a strategy. In my opinion, there's no one true way to do it. I believe it's something that each side of the trade can be hedged. I believe each side of the trade can be hedged. So there's no wrong way to do this as long as you understand that when you unbox and either go net long or net short, you understand the risk.